Hi folks, David Waring here again with LearnBonds.com, and today we're going to be talking about shorting bonds. It's very difficult to make money shorting individual bonds. The reason why is because you have to cover two costs before you make any money on your short position. First, when shorting a bond or a stock, you do so on margin, and you have to pay interest on that margin. Second, you also have to pay the interest on the bond to the bondholder who you borrowed the bond from to short. Unless you're trading very large amounts of money, you're probably going to pay in the neighborhood of 7% in margin costs for borrowing the bond. Assuming the bond has a 5% coupon and you hold the short position for 1 year, then the bond has to fall in value by 12% before you make any money. Most bonds are less volatile than stocks, so 12% will be a very large move. So are you out of luck if you want to short a bond? No. This can be accomplished with bond ETFs. You can learn more about shorting bonds using ETFs in the link that I've included below this video. Don't know what shorting is? Normally when people think about investing, they think about buying a specific investment and profiting from the increase in its value, interest, or dividend payments made by the investment. What many investors do not know, however, is that through a technique known as short selling, you can also profit when a security falls in value. When a trader sells a security short, what they're technically doing is borrowing the security from another trader and selling the borrowed security. If the price of the borrowed security falls in value like the trader is anticipating, then he can go in the market and buy the security back after the price has fallen for a price that is less than what he received when he sold it. He can then return the security to the original owner and pocket the difference between the price where he sold it and the price where he bought it back. Here's an example. Let's say Microsoft stock is trading at $50 a share, and you think it should be valued closer to $40 a share. You therefore sell 100 shares of Microsoft short at $50 per share. Your broker finds 100 shares of Microsoft for you to borrow to execute the short sale, and your account is then credited with $5,000. A month later, Microsoft falls to 40 like you expected, and you close your short trade by buying the 100 shares back at $40, a total cost to you of $4,000. As you are able to return the same 100 shares that you borrowed and sold for $5,000 for a price of $4,000, you have made a profit minus any transaction fees of $1,000 on this trade. That's our lesson for today. Please feel free to leave any comments or questions in the comment section below. For more great bond news and education, also be sure to visit us at LearnBonds.com, follow us on Twitter at LearnBonds, and like us on Facebook at Facebook.com/LearnBonds page. Thanks for watching.